Ever feel like the government's big economic decisions are happening behind a curtain?
Hmm.
You see they affect your job, your savings, the price of groceries, maybe, but the exact connection feels a bit like a secret code.
Uh-huh.
Today, we're pulling back that curtain just for you and trying to make sense of it all.
Exactly. We're going to take a real deep dive into the world of economic policy, basically. The
Yeah.
strategies and tools governments use to, well, steer the economy.
Right.
Think of it as getting a clear understanding of how the economic engine of our country is managed and the levers that get pulled to influence its direction.
And our mission on this deep dive to extract the crucial insights from the notes we have specifically, our CSC Chapter 5 notes on economic policy.
Yep, those ones.
We're zeroing in on the two big tools. Fiscal policy, which is all about government spending and taxation, and monetary policy, the Bank of Canada's world, interest rates, that kind of thing.
And the challenges, too. Can't forget those.
Absolutely. We'll definitely tackle the real-world challenges of making these policies actually work.
And these notes, they're packed with foundational knowledge. They give us a great framework for understanding the core concepts and how these different policy areas interact.
So how the government's choices about, say, where to spend money and who to tax
That's fiscal policy right there.
meshes with the Bank of Canada's decisions about the cost of borrowing, the availability of money.
That was monetary policy, exactly. It's all connected.
Right. We're talking about finally understanding why a government decision to build a new bridge might actually have a real impact on your local businesses, or why the Bank of Canada tweaking interest rates just a bit can influence your mortgage payments.
There can be some surprising connections for sure.
Get ready for some of those connections. Okay, let's dive right into fiscal policy. Government spending and taxation. In simple terms, what's it all about?
Okay, so at its core, fiscal policy is how the government uses its financial power spending and taxing to influence the economy.
Right.
The power comes from, well, how much it spends on things and how much it brings in through taxes. The big goal here is trying to influence the overall level of economic activity, keep employment up, foster growth long term.
It sounds like a balancing act.
It really is. It's a bit like a pilot constantly adjusting the controls to keep the plane flying smoothly, through different economic weather.
A pilot adjusting controls. I like that analogy. Now, when we talk about government spending and taxation in Canada, it's not just one big entity making all the calls, right?
Yeah.
Who's responsible for what?
That's a really important point. Yeah, in Canada, fiscal policy responsibilities are shared. You've got the federal government and the provincial governments.
Okay.
The federal government typically takes the lead on national stuff, things affecting the whole country, things like national defense, employment insurance, pensions, federal ones, veterans affairs, foreign affairs, indigenous and northern relations. That sort of broad national level stuff.
Okay, so the feds handle the big picture national things. What kind of stuff falls under provincial jurisdiction then, spending and taxing wise?
Right. Provincially, the focus shifts more towards daily life within that province. The biggest item for most provinces, healthcare, funding hospitals, doctors, all that.
Makes sense.
Education is another huge one, K-12, post-secondary. Provinces also oversee securities regulation, the rules for investment markets within their borders, and a whole range of other social services.
So healthcare, education, market rules.
But it's crucial to remember there's overlap too, shared responsibility. And the federal government sends significant transfer payments to the provinces.
Ah, right, those transfers we hear about.
Yeah, to help fund those shared areas like healthcare and education.
Yeah.
So provinces deliver the service, but federal money often helps pay for it.
Okay. Now, the federal budget, we always hear about it being released each year. What exactly is that document, and when does it usually come out?
The federal budget is basically the government's annual financial plan. Think of it like a detailed roadmap. It outlines how they plan to spend taxpayer money and where they expect to get that money from the revenue side for the upcoming fiscal year.
And that fiscal year is?
In Canada, it runs from April 1st to March 31st of the next year. So the budget document breaks down projected spending across departments, anticipated revenue from taxes and other sources, and, really importantly, whether they're forecasting a surplus.
Meaning more money coming in than going out.
Exactly. Or a deficit.
Spending more than they bring in.
Yep. Or a balanced budget, where revenue and spending are roughly equal. It's a key signal of their fiscal priorities for the year.
Surplus good, deficit not so good, balanced is the ideal. Got it. But what happens when they run a deficit? That's where national debt comes in, right? How are those connected?
Precisely. The national debt is basically the sum total of all the past federal deficits, minus any years where they ran a surplus.
So it accumulates over time.
It does. If the government spends more than it brings in a year, that's a deficit. It has to finance that shortfall somehow, mostly by borrowing money from financial markets. They issue government bonds, treasury bills, basically IOUs.
Yep.
Individuals, institutions, even other countries buy these. They're lending money to the government, which promises to pay it back later with interest. All those borrowings add up over the years to become the national debt.
So the government takes out loans like people or businesses might.
Yeah.
Is there a potential downside to the government racking up a lot of debt? I've heard the term crowding out mentioned.
Yes, you're right to bring that up. Significant, persistent government borrowing can lead to this thing called crowding out.
Okay, what's the idea?
The basic idea is when the government borrows huge amounts, it increases the overall demand for funds in the financial markets.
Right.
This increased demand can push interest rates up for everyone. And when rates go up, it gets more expensive for businesses to borrow money for, investing in new equipment, expanding, even managing cash flow.
So government borrowing makes it harder for businesses to borrow.
Potentially, yes. Heavy government borrowing can indirectly crowd out private sector investment because borrowing costs become too high. Some economists think this effect is quite significant, hindering long-term growth. Others think it's more limited, depending on conditions.
That makes sense. So the government's fiscal choices, spending, taxing, they have a very real direct impact. Can you give some concrete examples of how these levers actually affect things like jobs and economic growth?
Absolutely. Let's take government spending first. Imagine the government decides on a big infrastructure project, like building a new rapid transit line.
Okay, a big project.
That spending directly increases the government spending in our GDP, gross domestic product. That's a key measure of economic output.
Right.
But it doesn't stop there. To build this line, they need to hire construction workers, engineers, architects, managers, lots of people.
So job creation.
Exactly. These people earn income, and then they spend it on groceries, rent, entertainment, whatever. That boosts consumer spending, the C in GDP, which is huge.
Okay, so a ripple effect.
Definitely. Plus, the businesses supplying materials, concrete, steel, equipment rentals, they see more revenue. They might expand, invest more, hire more people themselves. That boosts business spending and investment, another part of GDP.
Wow.
So one government project can create ripples throughout the whole economy, boosting activity and jobs far beyond the initial spending.
So it's not just about better transit, it's like injecting money into the economic bloodstream. What about the other side, taxation? How does the government use taxes to influence things?
Well, taxation is mainly how the government collects revenue for all its programs and services. But it's also a powerful tool to influence economic activity.
How so?
Okay, say the economy's slowing down, maybe heading into a recession, unemployment's rising. The government might decide to lower personal income taxes.
Okay.
This leaves more disposable income in people's pockets, more money to spend. The hope is this increased consumer spending boosts demand, encourages businesses to produce more, maybe hire more workers.
Stimulate demand.
Exactly. Or they might lower corporate income taxes, make it more profitable for companies to invest in new equipment, R&D, expansion, which also can lead to jobs and growth.
Okay, so lower taxes can act as a stimulant. What about the flip side? When the economy is growing too fast, maybe inflation is becoming a worry.
Right. In a high inflation environment, prices rising rapidly, the government might consider increasing taxes to cool things down.
How does that work?
Higher personal income taxes leave consumers with less money to spend, reducing overall demand. If there's less demand, businesses might have less power to raise prices, helping control inflation.
Makes sense.
Similarly, increasing corporate taxes could reduce business profitability, potentially leading to less investment, slowing growth, and easing inflationary pressures. The goal is less money circulating, dampening spending.
This is all really illuminating. Now, our notes mention two key economic theories with different views on fiscal policy effectiveness: Keynesian economics and monetarist theory. Can you break down the main ideas?
Certainly. Keynesian economics, named after John Maynard Keynes, a very influential economist, strongly advocates for active government intervention, especially during downturns.
Okay, interventionists.
Keynesians believe that during a recession with high unemployment and low demand, the government should step in, increase its own spending, even run a deficit short-term, and not cut taxes. Give people and businesses more money to spend.
The goal there.
To boost aggregate demand, get the economy out of the slump. Conversely, during booms or high inflation, Keynesians would say, do the opposite. Cut government spending, maybe raise taxes to cool things down.
Right.
So in the Keynesian view, fiscal policy is a powerful tool to actively manage the business cycle's ups and downs.
So the government as an economic thermostat adjusting spending and taxes, how does the monetarist view differ? Sounds quite different.
Yes, monetarist theory folks like Milton Friedman were key figures here. Takes a much more skeptical view of using fiscal policy for active management. Monetarists argue that changes in the money supply, the total amount of money circulating, are the main drivers of economic fluctuations, including inflation.
Money supply is key for them.
Exactly. They believe the main focus should be on monetary policy, the central bank controlling money supply and interest rates to maintain stability and control inflation.
So less focus on government spending and taxes.
Generally, yes. Their core recommendation for monetary policy is steady, predictable growth in the money supply, aligned with the economy's long-run potential. They worry fiscal policy is prone to political bias, has long, unpredictable lags, and might be less effective than sound monetary policy for stable growth and low inflation. They tend to favor a smaller government role overall.
Okay, so Keynesians. Government steps in with spending taxes. Monetarists focus on managing the money supply via monetary policy. Clear distinction. Now let's switch gears to the main player in monetary policy in Canada, the Bank of Canada. What's its fundamental role, its key responsibilities?
Right, the Bank of Canada, often just the bank, is our central bank. Set up in 1934, government-owned since 1938. Its main overarching mission is promoting Canada's economic and financial well-being.
Promoting well-being.
And crucially, while it's government-owned, it operates with significant independence in its day-to-day monetary policy decisions.
Why is that independence important?
It's considered essential, so decisions are based purely on economics, free from short-term political pressures. That said, ultimate responsibility for overall economic policy direction still rests with the elected government.
So government sets broad goals. The bank decides how best to achieve them with monetary policy tools. Makes sense. What are the main areas of responsibility for the bank in fulfilling its mission?
Several key areas. The most prominent is monetary policy. Like we touched on, the primary goal here is preserving the Canadian dollar's value by keeping inflation low, stable, and predictable.
Inflation target.
Exactly. Currently 1% to 3%. They use tools, mainly influencing interest rates, to hit that target. They also oversee our flexible exchange rate system.
So keeping inflation in check is job one. What else?
Another critical area. Responsibility for the Canadian financial system. Promoting and maintaining a safe, sound, efficient system.
How do they do that?
Several ways. They oversee key clearing and settlement systems. The big one now is LINKS, for large electronic payments between banks. They work closely with other regulators like OSFI for overall stability.
OSFI, right.
They provide liquidity to markets in times of stress, advise the federal government on financial matters, and importantly, act as the lender of last resort.
Lender of last resort, meaning?
Meaning they stand ready to provide emergency loans to financial institutions facing temporary liquidity shortages. It's a safety net to prevent wider financial crises, kind of a backstop.
A crucial safety net. Any other big roles?
Yep. They're solely responsible for physical currency, designing, printing, distributing all our banknotes. Every bill in your wallet is their responsibility, ensuring enough supply, security features against counterfeiting.
Okay, the actual cash.
And finally, they act as the fiscal agent for the Government of Canada, managing a lot of financial operations for the government.
Like what?
Maintaining the government's main bank accounts, managing Canada's official international reserves, holdings of foreign currencies like US dollars, euros plus gold, and, very significantly, managing the federal debt.
Managing the debt involved.
Issuing new treasury bills and bonds, making interest payments on outstanding debt, tracking ownership, refinancing debt as it matures. They also advise the government on new debt issues, type, rate, term, based on market conditions, aiming for stability and cost effectiveness.
Wow, so the bank does way more than just set interest rates. It's really a central pillar of our financial system. Let's dive deeper into that core function, monetary policy. How exactly does the bank implement its decisions?
Okay. The fundamental aim, again, is keeping inflation low, stable, predictable. The bank believes this is the best way it can contribute to sustained economic growth and job creation by fostering a stable environment for decisions.
And the tools they use?
Primarily three main tools. The target for the overnight rate. That's their key policy interest rate. Open market operations, buying and selling government securities. And though less highlighted now, managing government deposits via drawdowns and redeposits.
Okay, let's start with the cornerstone, the target for the overnight rate. What is the overnight rate, and how does setting a target ripple through the economy?
Right. The overnight rate is basically the interest rate. Major Canadian financial institutions, like the big banks, charge each other for very short-term loans, usually just one day, hence overnight.
Okay, bank-to-bank loans.
And the Bank of Canada sets a specific target for this rate. This target acts as a key benchmark for pretty much all other interest rates in the economy: mortgages, business loans, everything.
How does changing the target work?
When the bank raises its target, it signals tighter monetary policy. It gets more expensive for banks to borrow, so they usually raise rates for their customers. Higher borrowing costs tend to dampen spending and investment, cooling inflation.
And lowering the target.
That signals easing. Borrowing becomes cheaper for banks, usually passed on as lower loan rates for consumers and businesses. This encourages borrowing and spending, stimulating activity during a slowdown.
So if they lowered it from, say, 1.0% to 0.75%.
Exactly. The intention is to make borrowing more attractive, encourage more economic activity.
So the target rate is the main signal influencing borrowing costs everywhere, but the actual rate banks charge each other. Does it always hit that target exactly?
Not perfectly, no.
Yeah.
The actual rate can fluctuate a bit during the day based on supply and demand for funds between banks.
So how do they keep it close?
They operate within a 50 basis point range, called the operating band. The target is always the midpoint of this band.
Example.
If the band is 1.5% to 2.0%, the target would be 1.75%. And a basis point is just 1/100th of a percentage point, so 50 basis points is 0.5%.
Okay, band, target in the middle. What defines the edges of the band?
The upper limit, 2.0% in our example, is the bank rate. That's the rate the Bank of Canada is always willing to lend at overnight to major institutions in Payments Canada.
The ceiling.
Right. And the lower limit, 1.5%, is the rate the bank is willing to borrow at overnight from those same institutions. This floor and ceiling, the bank's willingness to lend and borrow at these rates, helps keep the actual overnight rate trading within that band.
And they announce changes regularly.
Yes, 8 preset dates a year for announcing target rate changes. Provides predictability.
Okay, target is the bullseye, operating band around it, bank rate is the ceiling, borrowing rate is the floor. What about open market operations? How do they help keep the rate in the band?
Right. Open market operations are the bank's main tool for influencing liquidity, the amount of cash in the system, and keeping the overnight rate in the band day to day.
What kinds?
2 main types: overnight repos, repurchase agreements, and overnight reverse repos.
Let's start with repos.
Okay, the bank uses repos when it wants to inject cash and push rates down, especially if the overnight rate is trading above the target.
How does it work?
The bank purchases government treasury bills from a financial institution overnight. With a solid agreement, the institution buys them back the next day at a slightly higher price.
So a temporary purchase.
Exactly. This injects cash reserves into the institution's account at the bank, increasing overall liquidity. More cash around means banks rely less on borrowing from each other at higher rates, pushing the overnight rate down towards the target.
Can you give an example?
Sure. If the upper band limit, the bank rate, is 2.0%, but the market rate is trading higher, say 2.10%, the bank might offer repos at 2.0%. This encourages banks to borrow from the bank at the bank rate, increasing the supply of funds, easing upward pressure.
So a repo is like the bank temporarily buying something to pump money in lower rates. What about reverse repos? Sounds like the opposite.
Precisely. Overnight reverse repos are used when the bank wants to withdraw cash and push rates up, maybe if the overnight rate is below target.
So how do they work?
In this case, the bank sells treasury bills to an institution overnight, agreeing to buy them back the next day. This temporary sale removes cash reserves from the institution's account, reducing liquidity.
Less cash available.
Means banks might need to borrow more from each other, potentially at higher rates, pushing the overnight rate up towards the target. The rate on these is usually the bottom of the band, bank rate minus 50 basis points.
Repo in, rates down, reverse repo out, rates up. Got it. Now, you mentioned links earlier, the payment system. How does that tie into implementing monetary policy?
Right. Links is Canada's system for big, urgent electronic payments between financial institutions. It plays a fundamental, maybe behind-the-scenes role.
Right, so.
It's where banks ultimately settle their daily payments with each other. At the end of each day, every bank needs a zero balance in its settlement account at the Bank of Canada.
Okay.
The fact the bank stands ready to lend at the bank rate, the ceiling, if a bank is short, and borrow at the floor rate, bank rate minus 50 points, if a bank has excess funds. Well, that provides that firm ceiling and floor within the link system.
Ah, it reinforces the band.
Exactly. This constant process ensures the actual overnight rate consistently trades within the bank's target band. Links is the critical infrastructure making the bank's interest rate signals effective.
So links is the plumbing, making sure the signals flow. You also mentioned drawdowns and redeposits of government funds. Are those still actively used?
Well, perhaps not as front and center as the target rate and open market ops these days, but drawdowns and redeposits are still tools the bank can use to influence short-term liquidity and rates.
How does a drawdown work?
A drawdown is when the bank transfers government funds from chartered banks to its own account. This drains cash reserves from the commercial banking system.
Less money for banks to lend.
Right, reducing lending money, putting upward pressure on short-term rates.
And a redeposit.
That's the opposite. The bank transfers funds from its account back to the chartered banks. This increases deposits and reserves in the system.
More money available.
Increases money supply, typically pushes short-term rates down. They're another lever for fine-tuning liquidity, though maybe used less actively day-to-day now.
This gives a much clearer picture of how the bank operates. Now, making all these fiscal and monetary policy decisions, implementing them effectively, it can't be simple. Our notes highlight significant challenges. What are some major hurdles?
You're absolutely right, it's complex. Several big challenges. One of the most persistent, timing lags.
Lags.
Yeah, several kinds. First, the recognition lag.
Yeah.
Just the time it takes policymakers to realize a problem like a recession or rising inflation actually exists and isn't just noise in the data.
Data takes time to confirm trends.
Exactly. Then, the decision lag. The time to analyze, decide on the right policy, get it approved. This can involve debate, political processes, especially for fiscal policy needing legislation.
Okay, recognition decision then.
The implementation lag. Time to actually put the policy in place.
Yeah.
Fiscal policy, especially big spending projects, can take a long time here. Planning, contracts, building. The impact lag. Time for the policy's full effects to ripple through the economy. For monetary policy changes impacting inflation, that can take 18 months, 2 years, even longer.
Wow.
These lags make fine-tuning incredibly hard. Policies might even have unintended consequences if the economy has already changed by the time they fully hit.
Like trying to steer a giant ship that responds slowly. Sounds tough.
What else? Political considerations. These often play a big role, especially in fiscal policy.
How so?
There's the idea of the political business cycle. Politicians might be tempted by popular moves like tax cuts or local spending, especially near elections, even if they aren't economically the best timing.
Election cycles influencing policy.
Yeah, these politically motivated actions can lead to poorly timed or misaligned fiscal policies, potentially making things less stable, not more. Monetary policy, with the bank's independence, is more insulated, but even central banks face scrutiny.
That makes sense. Short-term politics versus long-term economics. What about how people and businesses react? Does that cause issues?
Absolutely. Future expectations held by consumers and businesses hugely influence policy effectiveness.
How?
Like, if the government announces a temporary tax cut to boost spending, but people think it's only temporary and taxes will just go back up soon.
They might just save the money instead of spending it.
Exactly. The intended stimulus effect gets muted. Similarly, if businesses are uncertain about policy sustainability or future interest rates, they might hesitate on big investments, even if borrowing is cheap now. Expectations matter a lot.
So policy credibility and perceived prominence are key. What about Canada being a federation? Federal, provincial, municipal policies interacting.
Yes, the coordination of federal, provincial, and municipal policies could be a real challenge. Canada's diverse. Different regions can have different economic conditions simultaneously.
Right.
A national policy like a Bank of Canada rate cut to help a struggling region might accidentally fuel inflation or housing bubbles in a region already booming.
Mismatched effects.
Yeah. And aligning different levels of government fiscal policies with national monetary goals is complex. The feds might be trying to cool the economy while provinces are boosting spending. Conflicting signals reduce overall effectiveness.
And we can't ignore high federal debt. How does that burden affect policy?
A high federal debt level definitely constrains fiscal policy. A big chunk of annual revenue has to go just to pay interest on that debt.
Less money for other things.
Exactly. Reduces flexibility for new programs, tax relief, or even responding effectively to downturns with stimulus. Plus, high debt can make it politically harder to implement necessary contractionary policies, spending cuts, tax hikes, because they're unpopular. Fear of adding more debt can also make governments hesitant.
Right. Those interest payments really limit options. And of course, Canada is part of a global economy. How do international factors play in?
The impact of international economies is crucial. We're an open economy, heavily reliant on trade, especially with the U.S.
So what happens there affects us.
Big time. If the U.S. has a recession, demand for our exports drops, potentially causing problems here, regardless of our domestic policies. Job losses, slowdowns.
And inflation.
Same idea. If our trading partners have high inflation, we pay more for imported goods, contributing to our own domestic inflation, even if our demand isn't that strong. Exchange rates, influenced by global factors, also play a big role in trade and prices. Policymakers here always have to watch the global picture.
So definitely not an economic island. Tied to global tides. Now, our notes have a helpful summary table comparing fiscal and monetary policy approaches for different situations. Can you walk us through that?
Sure, when the economy faces unemployment or recession, the typical fiscal policy response is expansionary.
Meaning?
Increase government spending, infrastructure, social programs to boost demand directly, and or decrease taxes, leave more money with consumers, businesses to encourage spending and investment.
Okay. And monetary policy in that situation.
The Bank of Canada would typically decrease interest rates. Makes borrowing cheaper, encouraging borrowing, spending, investment, stimulating activity.
Okay, that makes sense. Spend more, lower borrowing costs to get money flowing. What about when the problem is high inflation?
Right, when prices are rising rapidly, the typical fiscal policy response is contractionary.
The opposite.
Exactly. Decrease government spending to reduce overall demand and or increase taxes to take money out of circulation, reducing spending power, easing price pressures.
And monetary policy's response to high inflation.
Also contractionary. Increase interest rates, makes borrowing more expensive, discourages consumer spending and business investment, cooling overall demand, helping bring inflation down.
So policy levers reversed. Expansionary for recession, contractionary for inflation. Good summary. Finally, the notes outline pros and cons for both policy types. Let's touch on those. Starting with monetary policy main strengths and weaknesses.
Okay, a key advantage of monetary policy. Changes can often affect financial markets and borrowing costs more immediately than some fiscal measures, especially big spending projects.
Quicker impact sometimes.
And decisions can be adjusted relatively quickly. Plus, crucially, its operational independence means decisions are largely free from short-term political pressures, boosting credibility.
Okay. Downsides.
Significant disadvantages, too. Its effects are broad, hard to target specific regions or sectors precisely. Lowering rates might not work if confidence is rock bottom, the liquidity trap idea. People just won't borrow or spend.
Right.
And there's the zero lower bound interest rates can't go much below zero, limiting the bank's power in severe downturns.
Okay, quicker, independent, but less targeted, limited at zero. What about fiscal policy's pros and cons?
On the advantage side, government spending can be targeted regions, industries, specific groups. Infrastructure creates local jobs. Tax credits help specific people.
More direct targeting possible.
And tax cuts or benefit increases can have a more direct, immediate impact on people's disposable income than monetary policy's indirect effects.
Downside.
Considerable disadvantages. Implementation can face long legislative processes. Implementation lags. Tax hikes, spending cuts are often politically unpopular, hard to enact.
True.
Big spending projects, once started, are hard to stop or change, even if conditions shift. And maybe most significantly long-term. Persistent deficits and high spending increase national debt, meaning higher future interest payments, constraining future options.
This has been an incredibly detailed, really insightful deep dive into economic policy. We've unpacked fiscal and monetary policy, the Bank of Canada's role, the real-world challenges. Hopefully you, our listener, now have a much clearer, more nuanced understanding of the forces shaping our economic landscape.
Absolutely. Understand these fundamentals gives you a valuable framework for interpreting economic news, analyzing government actions, and just being a more informed citizen. It helps demystify what can seem pretty complex.
So, with all this in mind, considering those long impact lags for both policies, the need to anticipate future shifts, how can individuals and businesses best prepare for potential economic changes on the horizon? It's definitely a complex question, something worth pondering. Thanks so much for joining us for this deep dive.